Hello, and welcome to the virtual classroom where today we will be looking at the accounting cycle from the perspective of a merchandising company. In previous videos, the transactions we saw were recorded from the perspective of a service company. A service company actually sells its time rather than providing a product. Examples of service companies are listed here. If you think about a landscaping company, someone says, I'm going to mow lawns, or someone says that I'm going to teach kids how to play basketball. Those are examples of companies that sell their time by providing a service. With a merchandising company, these companies purchase finished products from other companies and then they sell those products to end users, or sometimes they'll sell them to other merchandisers. So companies like Costco, Walmart, those retail companies, those are merchandising companies. So just to refresh your memory, remember the accounting cycle begins with us analyzing our source documents. We then prepare journal entries and we post those journal entries by transferring them from the journal to the ledger so that we can calculate our balances. And then we take all of those balances and we create what's known as an unadjusted trial balance. From there, we ensure that debits equal credits. And then we do our adjusting entries. Adjusting entries are needed because of the passage of time. And with the way GAAP requires that we record our transactions, there are some things that we need to record manually. So we have to do adjusting entries for certain items. And then we post those adjusting entries and we prepare another trial balance, the adjusted trial balance. And from there, we create our financial statements. Our financial statements are prepared in the order of the income statement, the statement of owner's equity, or the statement of retained earnings and stockholders' equity, if we're looking at a corporation. Then we prepare the balance sheet and finally the statement of cash flows. Once we have prepared our financial statements, it's time to get our records ready for the next period. And we do that through the use of closing entries. After we prepare our closing entries, we post again, and then we create the post-closing trial balance. This same accounting cycle that we saw for a service company still applies to a merchandising company. A couple of new accounts that will show up on the balance sheet for a merchandising company is the merchandise inventory account. When we purchase those finished products to resell later on to end users, those items become assets to us. Those are resources that we own and control. We specifically call those assets inventory. Inventory is a current asset and it is, of course, on the balance sheet listed in order of liquidity. So typically you'll see cash, then accounts receivable, and then you will see merchandise inventory. But just keep in mind, these are goods that we have purchased to resell later on. Companies account for merchandise inventory using two systems. There is the perpetual inventory system and the periodic inventory system. Under the perpetual inventory system, we constantly update our inventory records every time we have a transaction related to inventory. This means that if we go into a store and we purchase something, let's say we go into Walmart, we purchase something, and when we pay for it, we scan it, Walmart immediately knows that there is one less of that item in its store because they are using the perpetual inventory system. We can compare this to maybe a lemonade stand that happens to sell cupcakes as well. And somebody comes up and buys a cup of lemonade and a cupcake. In that example, at the end of the day, the person selling the cupcakes will take a tally of what they have left and then determine how many they've sold based on what they have left. So they only update their inventory records once a period or at the end of each period. Typically, the periodic inventory system requires the company to take a physical count of the inventory to determine how much inventory they actually have left. With a perpetual inventory system, a physical count is usually taken at the end of the accounting period, which could be once a year, whereas under that periodic system, it's usually once a month. In this video, we're going to focus on the perpetual inventory system. So let's look at some transactions. It's time to prepare some journal entries. So in this first one, we have Cool Kicks paying $5,000 cash for merchandise inventory. Remember that merchandise inventory is an asset. And when we purchase merchandise inventory, we are getting more inventory or increasing our assets. And when we do this, that means we should debit merchandise inventory for 5,000, and we're using cash to get the inventory, so we credit cash. In the next transaction, Cool Kicks purchased $5,000 of merchandise inventory, terms 210 net 30. Whenever you see these terms listed here, this is an indication that the inventory was purchased on credit. These terms are actually called credit terms. And we're going to look at what each one of these components means in a second. So again, this is read as 210 net 30. The 2 is the discount percentage. The 10 is the discount period. The net 30 is the credit period. So here's what this means. If we pay for these goods within 10 days of the invoice date, then as the buyer, we are allowed a 2% discount. We can knock 2% off of the invoice price. If we don't take advantage of this discount, then the full amount is due within 30 days. Again, whenever you see these terms, it's an indication that the goods are purchased on credit. So that means we are going to need to credit accounts payable rather than crediting cash. The additional information in terms of the numbers tells us what our discount percentage is, how long we have to take advantage of that discount, and when the full amount needs to be paid. So now let's see this entry. For this entry, we debit merchandise inventory or inventory for 5,000 and we credit accounts payable. Using the gross method, because there are two ways that we can account for a purchase discount. That's what this whole thing is called here, a purchase discount. Using the gross method, we don't do anything with the discount percentage until we know we're going to take advantage of it. So on the day we purchase the goods, we debit inventory and credit accounts payable for that full amount. Now let's see the entry for when we pay within the discount period. When we pay within the discount period, we have to calculate the amount of our purchase discount. And we do this by taking the 5,000 and multiplying it times 2%. That gives us $100. The amount of cash that we're going to pay out is the original invoice amount less the purchase discount of $100 that we just calculated. So the 5,000 minus the 100 is the 4,900. The 5,000 then gets debited to accounts payable. Now, I dealt with calculating the purchase discount first, but I didn't talk about which account this actually impacts. Under the perpetual inventory system, we're constantly updating inventory records. So everything that happens to the inventory account needs to be included in that merchandise inventory account. And GAAP requires that whatever we have to do to the inventory to get it to a point where we can sell it, and the cost of the inventory, all of that stuff needs to go into the inventory account. So what does that mean? Well, how much did we really pay for this inventory? Did we pay 5,000 or did we pay 4,900? Based on the second entry, we paid 4,900. The purchase discount will actually reduce the merchandise inventory account so that I can show inventory at the amount that I actually paid for it. So under this gross method, yes, we recorded inventory initially at 5,000, but because we paid 5,000 less 100, we have to deduct that purchase discount from the merchandise inventory account. So when you do the entry for the cash payment, we debit accounts payable for the full amount of the invoice. We credit merchandise inventory for the purchase discount, and we credit cash for the original invoice amount less the purchase discount. Now, let's see what happens. Let's pretend this entry in the middle doesn't happen at all. And let's pretend that we delay and we pay after the discount period. Now, I don't know why we would do that. Maybe we don't have cash on hand, but not taking advantage of the discount in certain situations is similar to paying 30% interest, 36% interest in some cases. So most companies will take advantage of the discount. But if the company doesn't take advantage of the purchase discount, then the entry at the bottom is what we would do. We would debit accounts payable and credit cash. Now let's see the net method. So same scenario, same information, only instead of using the gross method to record our purchases, we are going to use the net method. So in the initial entry where Cool Kicks purchased $5,000 of merchandise inventory, we still debit merchandise inventory and credit accounts payable. But under the net method, we record the amount net of the discount immediately. So we operate under the assumption that we are going to take advantage of the discount. So rather than debiting for $5,000 and crediting for $5,000, we debit for the $4,900. And remember that $4,900 is $5,000 times 2%. And we take that $100 and subtract it from that $5,000. And that's where we get the $4,900 from. Now, when the inventory is paid within or paid for within the discount period, we just take accounts payable off the books by debiting accounts payable for that same $4,900 and crediting cash. We don't have to worry about dealing with reducing inventory for the purchase discount because we already did that in the first entry. Now, if we pay for the inventory after the discount period under the net method, we have to use this new account called purchase discounts loss. So yes, we debit accounts payable for the $4,900. The amount of cash that we're actually paying, it's $5,000 because we didn't pay within the discount period. But then we have this temporary account called purchase discounts lost that we need to take into consideration. And we're going to debit that for $100. We only use that if we pay after the discount period. And this account is linked with merchandise inventory. And again, it helps us show merchandise inventory at the amount that we actually paid for it. So purchase discounts lost is again linked with inventory, and it's going to increase that inventory account. We show this separately. So we don't just throw this in merchandise inventory. We show it separately because we want to keep track of purchase discounts lost. $1 in my hand today is worth more than $1 in my hand tomorrow. And when I don't take advantage of that purchase discount, it's equivalent to me losing money. So we want to keep track of how many discounts we actually lose under the net method. Now let's look at a purchase return and a purchase allowance. Sometimes when we purchase merchandise inventory, it may be the wrong color. It may be defective. So we may have to send it back to the seller, or the seller may give us a reduction in price. And we're going to get to see how we account for these purchase returns and allowances. So in this example, Cool Kicks returned $1,000 of merchandise inventory purchased in the previous transaction. Remember, we had those credit terms of $210 net $30. So because the merchandise was returned under the gross method, we are going to reverse the entry that we previously did when we purchased those goods. Remember, when we purchased those goods, we debited merchandise inventory, we credited accounts payable. Well, now we're going to do just the opposite, but only for the amount of the return. We return $1,000, so we're going to debit accounts payable for $1,000 and credit merchandise inventory for $1,000. This ensures that the amount that's showing in accounts payable is the amount that we actually owe. The seller's not going to make us pay for goods that we return. For merchandise inventory, the goods are no longer in my possession, so I can't keep them in the inventory account. We have to reduce that account. Now, under the gross method, remember, we don't do anything with that purchase discount until it's time for us to pay it. So we're going to use that full amount. If we were using the net method, the accounts would look the same, but we have to do the entry for net of the discount. So that 980 is actually 1,000 times 2%. And then we subtract that $20 from the 1,000, and that's where we get the 980 from. Transportation charges. Anything that we have to do to the merchandise inventory to get it to a point where we can actually sell it has to be included in the merchandise inventory account. So when goods are shipped and the buyer pays for those shipping charges, that cost has to be included in the merchandise inventory account. So goods can be shipped in a couple of different ways. When goods are shipped, FOB shipping point, the buyer pays for the shipping charges. When goods are shipped FOB destination, the seller pays. So FOB stands for free on board. And this is important because legal title passes to the buyer based on how the goods are shipped. When goods are shipped, FOB shipping point, the buyer owns those goods as soon as FedEx or UPS or whoever the shipping company is. As soon as they receive those goods, the buyer owns those goods. So when goods are in transit and they haven't reached the buyer's front doorstep yet, as long as the goods are shipped FOB shipping point, then the buyer owns those goods. This is also important because if the goods are lost or damaged in transit, the buyer suffers the loss. When goods are shipped FOB destination, the seller pays for the shipping charges and the seller owns those goods until they reach the buyer's front doorstep. In this case, the seller suffers any losses if the goods are damaged in transit. So an easy way to help you to remember this is look at the B, look at the S. If you think about this as a buyer, sometimes, especially if you're ordering goods off of Amazon, sometimes the shipping is more than what you're actually purchasing. And don't curse, but sometimes it's BS that the buyer has to pay for their own shipping charges. If I'm thinking about this from the perspective of being the buyer. So when goods are shipped, FOB shipping point, see the B and the S connected together, then the buyer pays for their own shipping charges. Now, from the standpoint of journal entries, why do I care? Well, if goods are shipped FOB shipping point, then some cash has to come out of my pocket as the buyer. So I have to do an entry. But if the goods are shipped FOB destination, then I don't have to do an entry at all because the seller is paying for the shipping charges. In this example, the goods were shipped FOB shipping point. So here's the entry. All transportation charges get recorded in the merchandise inventory account. So we debit merchandise inventory and we credit cash. So let's take a look at the summary of all of our transactions. When we purchase goods for cash, and all of these are using the gross method here. When we purchase goods on credit, you can see that in the second entry here. When we're paying for the goods within the discount period, when we purchase those goods on credit, then here's the entry for when we're paying for the goods after the discount period. Then we get to see the entry for goods that are returned. So this is a sales return or a sales allowance. Remember that with an allowance, we don't physically return the goods, but the seller gives us a reduction in price, but the entry is the same. And then for transportation charges. So just to summarize everything that happens in the merchandise inventory account, these are all the things that are included using that perpetual inventory system. The invoice cost, we subtract out any purchase discounts, we subtract out any purchase returns and allowances, but we add in any cost of transportation when goods are shipped FOB shipping point. And that will give us the total cost of our net purchases. That concludes this video. Hopefully you'll get an opportunity to watch the next one where we get to see the seller's transactions under the perpetual inventory system. I so appreciate your time and attention. Thank you for watching. Comment, like, and subscribe. Have a wonderful day.